Hi students, today I'm going to discuss another paper. This time is May-June 2021, paper 12. So my advice is first to try the paper, a full paper, and then you go back and see what you got wrong and with some explanation. So we're going to start straight away. Which statement about bookkeeping and accounting are correct? Accounting is performed periodically rather than daily, which is correct, because accounting is about preparing financial statement, which is not done on daily basis. What is done on daily basis is bookkeeping. Accounting relies on having accurate bookkeeping record. Yes, you cannot prepare accounting without a proper bookkeeping record. Bookkeeping include preparation of financial statement. No, financial statement is the task of the accountant, not a bookkeeper. So this one is wrong. So the answer we get here, bookkeeping involves recording of financial transaction. Yes, bookkeeping involves recording financial transaction. So the answer we are getting here is A. What increases the owner's capital? So here we have bank loan extended from 5 years to 10 years. No, this has nothing to do increasing the capital. You're just extending the loan. Purchases, the period of the loan, that is, purchases of inventory on credit. No, if you're purchasing whether on credit or for cash, you are just you have not increased the capital, because you are increasing inventory and also increasing the trade receivable, right? Purchases of machinery by check. No, this has nothing to do with the capital, because when you're purchasing machinery by check, it's just one asset, we change it into another asset. And a current asset is changing into a current asset bank. Transfer of a vehicle to a business from private use. Yes, if you transfer a vehicle from the business for private use, you're actually increasing the capital, because in the double entry, you're going to debit, to debit motor vehicle, and you credit capital, because the capital is increased since you are taking an asset outside and you are putting it into the business. So the answer is D. Let's move to number 3. William paid $500 in cash to Sonia for rent. How did Sonia record this? So we are recording as a Sonia and William paid. So if William paid, obviously the cash account is receiving, we debit, and the rent receivable is giving, we credit. So we're not going to involve Sonia account, because Sonia does not owe us anything. It's just paid rent for cash. So we don't have to open her account. So the answer is A. Let's move on to question number 4. Abdul buys machinery. On credit, he provides the following information. We have machinery cost 30,000, and this is the cost at the end. Then amount owing to suppliers 19,000. So during the year, Abdul paid 25,000 to a supplier for his machinery. How much did he owe on 30th April? So let's try to open a supplier account here. The supplier account, actually Abdul buys machinery on credit, and this is we don't know the name of the supplier, let's just call him the supplier, who had the balance brought down at the beginning of the year of 19,000. Yes, and then if he buys all his machinery on credit, and this was the balance at the beginning and the balance at the end of the machinery, which means the difference is showing us what he has actually purchased of 12,000. So he purchased some more machinery worth 12,000. Obviously, credit the supplier, right, and debited machinery. Yes, and he paid the supplier 25,000. So we debit the supplier and we credit bank or cash. Yes, and then the difference is going to show us how much he owes the supplier at the end. Right? So if I grab my calculator, right, and I take 19,000, let's start with the credit side, plus 12,000, then I take away 25,000, I'll actually get 6,000. So 6,000 is the answer. Right. Let's move on to question number 5. Schuler financial year ends on 30th March. On 1st April, there was a credit balance of $100 on Yassine's account in Schuler's purchases ledger. In other words, Schuler has actually purchased goods on credit, and is purchasing goods on credit, right? From this supplier called Yasmin, and he's owing Yasmin $100 because Yasmin is a supplier, right? So Schuler had paid, no, not pay. Schuler actually owed Yasmin 100. This is the correct answer because Schuler is a customer to Yasmin, who is a supplier. Now let's move to question number 6. Hasina buys radio from Nazneen at a list price of $10. Hasina bought 12 radio and was offered a 20% trade discount and 4% cash discount. 2 radios were $40 and were returned to Nazneen. What was the total of the credit note issued to Nazneen? Right. So if there were 2 radios, if we are talking about the credit note, means we are going to concentrate on the returns. So what has been returns is 2 radios, which cost $10 each, so $20 total of the radio which were returned. And there was a trade discount of 4%. Remember, we don't use the cash discount in this case because you want to calculate what is the total on the credit note. So on the credit note, it means what was actually appearing on the credit note. That means before the payment, because the cash discount is if he pays. The trade discount is deducted straight away on the invoice, and the cash discount is deducted when the customer pays, right? So it means in this case we only deduct the trade discount. So we calculate 4% of $20, which is 4. So 4% of 20, right? So it's 20 times 4 divided by 100, yes, which is actually 8, yes, right? So now we'll take the trade discount here. It was 20%, sorry, it's not 4%. So 20% of 20, right? Which is 4. Right? And then we take 20 minus 4 to get 16. So 16 is the correct amount, is the correct answer. Right. Number 7. Jamil sold goods on credit. Where did he first record the invoice he issued? Right? So if Jamil sold goods on credit and the invoice is actually recorded in the sales journal, right? Because the sales journal is the journal which records the invoice. When you're selling goods on credit, we record the invoices in the sales journal, right? So number 8, which statement about the 3-column cash book are correct? So remember, a 3-column cash book is a book where you record cash in and cash out, right? So all right, so now in this case the first option is it contains ledger. It contains ledger, account for bank and cash. Yes, it's correct, because in the cash book you only find the cash and the bank account, right? It contains ledger for discount allowed, discount received. No, this is actually the discount allowed, discount received are in the 3-column cash book just to be transferred to the nominal ledger. So discount allowed and discount received will appear in the nominal ledger, their total. So they are just kept in the cash book to record the entries, but they are accounts which are supposed to belong to the nominal ledger. Yes, it records transaction before they are recorded in the ledger. Yes, because the book of prime entry. So the answer for number 8 is actually this one is correct and this one is correct. So the answer is B. Let's move on to question number 9. Which statement is not true about the trial balance? Remember, trial balance is a list of balance of the ledger, of books of the list of balances of the ledger accounts at a certain date. Right. So, which is not true about the ledger. So, it is a list of ledger account balance at a certain date, which is very correct. It can assist in finding arithmetical errors. Very correct. Because if it doesn't balance, it means you know that there is some arithmetical error. It is a part of double entry. No, it's not a part of double entry. The trial balance, there is no debit and credit because just transfer the balances in the ledger. It is used to prepare financial statement. That's very correct. So the answer is C. Moving on to question number 10. Which error is an error of original entry? Error of original entry. It means it's an error which is made when the transaction is recorded for the very first time. So, sale of a surplus of office equipment on credit to Janet for 230, entered as 320 in both disposal account and Janet account. Very correct. This is an error of original entry. Why? Because the transaction has been entered for the first time wrongly when the asset was being sold. So, the answer is automatically A here. When it says sales of surplus of equipment on credit to Janet, enter an office equipment account and Jason account. So instead of Janet, we see Jason. So this is actually not an error of original entry, is an error of commission. Now, sales of surplus of equipment on credit to Janet, entered in sales account and in Janet's account. This is another error, which is an error of principle, because you are using sales account instead of using disposal account. So you have completely used the wrong class. Sales of surplus office equipment account and credit to Janet not entered in any account. This is an error of omission. So it is not error of original entry. Let's go to question number 11. A check, $85, received from Shakil was credited to the account of Shams. Which journal entry will record this? Well, this is straightforward, that when you are actually correcting this error, right? A check, 85, received from Shakil was credited to the account of Shams. So Shams was being credited wrongly. 85. Yet the account we're supposed to be credited is Shakir. Right? So in this case, what do? We debit Shams to cancel the account, and we credit Shakir to record in the correct account. So the entry is debit Shams and the credit Shakir. So the answer is D. Jamal bank statement on 1st May showed a bank overdraft of 1,460. At that date, there was an presented check of 385 and a credit deposit of 255. So I'm going to start from the bank statement to find the balance of the cash book. So that means I'm going to start from a document which is not updated to a document which is updated. Right? So the cash book is updated, but the bank statement is not updated. So any presented checks, I'm going to minus them from this balance because the bank has also minused them. Any credit deposit, I'm going to add them because they have actually been added in the cash book but not in the bank statement. So if I use my calculator and I work out this 1,460 negative 385. That means it is like you're adding, because it's negative and negative, and then you add 255. So the answer I'm getting is C, 1,590 credit. Because in the bank, there is, in the cash book, there is a negative figure, which means there is still an overdraft. Right. Question number 13. What is included in the purchase ledger control account? Cash purchases, no. Remember, when you're dealing with the control account, purchase control account, think about the supplier account. So what you do in the purchases ledger to the supplier account, remember, you debit the supplier when he receives and you credit the supplier when he gives, isn't it? So cash purchases can never go to the supplier account because this is a cash transaction. Bad debt written off has nothing to do with the supplier. Discount allowed, you don't allow discount to a supplier, you allow discount to your customers, but goods returned to credit supplier will obviously appear in the purchases ledger control account. Question number 14. Javid sales ledger control account had a debit balance of 12,000. Interest on an overdue account 40 and the discount allowed 150 had been omitted. What was the correct balance of the sales ledger control account? So when you're dealing with this control account, it's always advisable to draw an account. All right. So is the sales ledger control account. When you think about sales ledger control account, think about a customer's account. Normally, a customer has a balance brought down unless he has overpaid of 12 or on the debit side, right? So if there is an interest on overdue account of 40, it means you are charging him more. You have to debit him and the credit interest payable. Interest receivable, yes, because it's an income. And then and discount allowed 150. If you are giving him a discount, you have to reduce how much he owes you. You credit him 150 here, and of course you debit discount are allowed, and the difference will give you the balance that he owes you in the account, right? So if I take my calculator and work this out, okay, I'm getting 11,890, right? So let's move on to question number 15. Which statement about capital expenditure are correct? Remember, capital expenditure is about spending money on non-current asset. When you're buying non-current asset, or you're improving the value of non-current asset. For example, if you are buying a motor vehicle which had no a trailer, let's say a truck with its trailer. That means if you buy a trailer, you have added value. But if you have, for example, bought a motor vehicle and the tire are worn out and you replace them, it's not a capital expenditure, it's a revenue expenditure, right? So about statement of what is now capital expenditure here, we have options, right? It is money spent on day-to-day business operation. No, this is revenue expenditure. It is money spent on purchasing an current asset. Very correct. It is recorded in the statement of financial position. Yes, you remember that non-current assets are recorded in the statement of financial position. It includes expenses relating to non-current asset. No, expenses are actually recorded as a revenue expenditure. They are not capital expenditure. So that's why our answer for this question 2 and 3. Right. 16. Near sold equipment right? Nia sold equipment with a net wealth value of $200. The profit of the sale of $250 were credited to sales account and debited to the cash book. What was the effect of this error on Nia gross profit and the profit for the year? Right. So this question, you have to understand here that if the proceed on the sale of 250 were actually credited to the sales account, we have obviously overstated sales and obviously also overstated the gross profit by 250. So option A and B are already out. We have to look at the two options between C and D. So if you overstate the sales, you have also overstated the gross profit by the same amount of 250. But the profit for the year, since the net book value was 200 and the proceeds were 250, obviously this $50 is a profit, right? Which means the profit for the year was not overstated by 250, was only overstated by 200, because the 50 is already a profit which goes into the income statement. So the correct option is C, right? Because the profit for the year was not understated, but was overstated. Okay. We are on question number 17. Why does a business provide depreciation of its non-current asset? To charge the cost of non-current asset against the profit for the year. No, this is nonsense. To ensure the non-current asset appear at the book value in the statement of financial position makes some sense. To ensure that the matching principle is applied when preparing the financial statement, this is which makes much more sense, because the whole reason why you provide the depreciation is actually to apply matching principle. So matching principle is not only to show the value of the asset in the correct asset in the statement of financial position, as said here, but it's also to record the proper and the correct expenses, because remember depreciation appears as an expense in the income statement. So this is correct, but partly. But the correct answer, which is fully correct, is the matching principle. To return cash in the business, no, this is not correct. Right. So let's go to number 18. A machine with an original cost of 10,000 had been depreciated for 2 years at the rate of 10% per annum using straight line basis. It was then sold for cash with the loss on disposal amounted 700. A replacement of machine was bought the same for 12,000. What was the depreciation? Okay, what was the net decrease in the cash balance? Now, here we are given the cost of the machine, which is 10,000, and the depreciation is 10% per annum on a straight line method, which means the depreciation is 1,000. So for 2 years is actually 2,000, right? Because they say it had been depreciation for 2 years at the rate of 10%. So that means the net book value is 8,000. Is that okay? Fine. So if the net book value is 8,000 and you have sold at a loss on disposal of 700, we have actually sold it at only 7,300. This is what came in, cash in. All right? And we bought, the same day we bought another machine for 12,000. So the cash out was 12,400. So the difference between 12,400, which is cash out, and 7,300, which is cash in, will give us the net decrease in the in the cash balance, right? So we work out that, right? And the answer we are getting here is B, 5,100. Question number 19. Why would a bakery business not include a value of inventory in stationery in the statement of financial position? It was expected that would be used in the next few months. No. It was purchased regularly and paid in cash. No. It was not for resale. No. It was a very low value. Yes. This is the concept of materiality. Materiality concept says there are certain things which are of very low value, which you cannot include as a statement of financial position. Right? So, Shilpa financial year ends on 30th April. On 31st March 2021, she wrote off a debt by Tahir as recoverable. Remember, Tahir is actually a customer who has a balance brought down on the debit side. So if you have to write off Tahir, we have to credit Tahir and the debit recoverable debt. So the entry to write off a customer is to credit the customer to cancel his account, and then you transfer this amount in the recoverable debt, so at the end of the year you transfer that in the income statement as an expense. Right? So you have to debit recoverable debts and credit Tahir. 21. How would inventory be valued? You know that this is something that inventory is always valued at net realizable value, lower of cost, and net realizable value. Right? Net realizable value, it's actually the estimated selling price minus selling expenses and other expenses which have put the product into a sellable condition. So if that value of net realizable value is lower than the cost, then you value the inventory at net realizable value, not at cost, to apply the concept of prudence. Right. 22. James is an accountant and operates as a sole trader. Which item would not appear in his statement of financial position? Remember, if it's an accountant, he has nothing to do with trading account, right? Because it is just a service business, right? So here we are told that a long-term loan, yes, an accountant can actually have a long-term loan, right? And then we also have return earnings, right? The question is, which item would not appear in his statement of financial position, right? So the return earnings cannot come in the income in the statement of financial position, and the trade payable can also not come in the statement of financial position because he's not trading, he's not buying and selling goods, he's actually giving services. So the answer is 2 and 3. Right. Zara is a consultant, is another service business here, who receives the fee from clients. How would Zara calculate his profit for the year? Right. So if Zara is actually a consultant, we don't expect something like cost of sales, because there is nothing like opening inventory plus purchases minus closing inventory, right? No cost of sales, so this is out already. Now, you cannot take fee receives and add expenses, but you take fee receives minus expenses to calculate the profit. So the answer is D. Now, 24. What is added to the owner's capital to calculate the capital employed? Please remember, capital employed is made of the capital, yes, plus long-term liability. Long-term liability is the money you borrow that you are going to use for a long period of time, for more than a year. So it is a part of the capital. So long-term liability is actually added to the capital to find the capital employed. 25. What is an advantage of forming a partnership? Decisions can be recognized by all partners. Each partner is responsible for action of other partners. Cannot be an advantage. Profit have to be shared. No, profit sharing is not an advantage. responsibility can be shared. This is a very simple question. 26. Anne and Ben are in partnership, sharing the profit and loss equally. So they provide the following information. So what was Ben's share of the residual profit? So if the profit was 20,000 and the interest on capital is for Anne and Ben is 9,000, so that means the residual amount which is going to be shared is 11,000. And drawings cannot be part of the profit sharing, isn't it? And this is what they have to share, and you divide by 2. Right? So if you divide this by 2, obviously, the answer will be 5,500. Okay. Let's go to question number 27. Which statement about a receipt and the payment payment account is incorrect? So receipt and payment, first of all, just understand that it's about cash in and cash out. It's like a cash book for a non-profit making organization. So it includes the amount prepaid, yes, because you don't have to make any adjustment. You have just to put any amount. There is no adjustment of prepayment and accruals. You just put any amount that has been received or has been paid. So this is correct. So it's not part of the answer. It shows the surplus. What shows the surplus? It's not the receipt and payment. What shows the surplus is the income and expenditure. So this is not correct. So I'm sure this could be the answer. Non-monetary items are included if you have a receipt and payment. It's incorrect. You actually have expected the cash in and the cash out, isn't it? Right? So you exclude anything which is non-monetary. Balance represent cash and bank balance, correct? So the answer is B, right? Let's move on to question number 28. How does a manufacturer calculate prime cost? So no, prime cost is all the direct cost, yes? So it's direct material plus direct labor plus direct expenses. So direct material plus direct labor plus direct expenses. 29. Nulla provide the following information for the year. What was the profit or the loss for the year? Right. Okay. Remember, to calculate the profit, you take the capital at the end, capital at the end, minus capital at the beginning, plus drawings, minus capital introduced. Why? Capital at the end minus capital at the beginning. You understand, if you had started with this money and you end up with some more money, the difference will give you the profit. Why do you add drawings? You add drawings because the drawings were taken from the business, from the profit. So you want to calculate the profit you have made, but because you have taken drawings, this profit would have been more. That's why you have to add them back. You want to find how much profit you made. And then minus any capital introduced, because capital introduced is not the money which is made by the business. It's made by, it's actually outside money, right? So here we don't have a capital introduced. We have capital at the end, which is 72,275, minus capital at the beginning, 60,500, and we add drawings of 3,900. So if we work out that, okay, so we are getting 15,675. So 29, the answer is D. Now moving on to 30. A trader provided the following information. What was the profit margin? Remember, the profit margin is actually the profit over sales times 100. The formula is a profit for the year over sales, gross profit over sales times 100, right? So what is the sales here? If we have got the cost of sales and the profit, this plus this is going to give us the sales, because normally take sales less cost of sales to find the gross profit, isn't it? Right. So which means the gross profit we have is the gross profit we have, the sales we have here is 80,000 plus 16,000, right? So if we take 80,000 plus 16,000, right? So 80,000 plus 16,000 will get 96,000. So 96,000 is the sale, right? And these sales less cost of sales. How do you find the cost of sales? Gross profit over sales times 100. Is that okay? Now, okay, sorry, there is a small mistake which is made here. Actually, the cost of sales is the sales is not 96. Yes, let's make a small correction here. The cost of sales is not known, and normally takes sales less cost of sales, and this cost of sales is 80,000 to find the gross profit, and the gross profit is actually 16,000 plus 4,000, which is 20,000, which means the sales is 100,000, right? And the profit for the year is 16,000. So which means to find the gross profit margin, we take 16,000 over 100,000 times 100, which is giving us 16. So 16%. So the answer is A. All right. Okay. So let's move on to question number 31. A trader provided the following information. Then it was found that the closing inventory should have been 400. What was the correct rate of inventory turnover? Right. Here we are not going to consider closing inventory as 300. We are going to consider closing inventory as 400. So opening inventory plus purchases with 2,700 minus closing inventory here, which means the gross profit is actually, the cost of sales is 2,700 minus 400. But now the question is, what is the correct rate of turnover? How do you find the correct rate of turnover? To find the correct rate of turnover is cost of sales over average inventory, right? So opening inventory plus purchases minus closing inventory will give us the cost of sales. So if I take a calculator, we take 100 plus 2,600, right? And then we minus 400, and the answer we get is 2,300. So 2,300 is the cost of sales. So 2,300 over average inventory. The average inventory is 100 plus 400 divided by 2. So 100 plus 400 divided by 2, which will give us 100 plus 400, that's 500 divided by 2, which is 250. So, which means the average inventory is now 2,300 divided by 250, right? And the answer we're getting here is 9.2, which is C. Right. Question number 32. Sally's business had reached the overdraft limit set by the bank of 1,500 and is not able to pay its debts when they fall due. Sally is considering the following proposal. Which proposal will improve the working capital of the business? Right. So, option number 1, asking the bank to increase the bank overdraft limit to 2,000. No, it's not going to improve the working capital. Option number 2, borrowing 2,000 from a relative to pay the money back in 6 months. If he pays back in 6 months, it's still short-term liability. So it's not going to solve the working capital. Right? Why? Because it's money payable in less than a year. Option number 3, obtaining a loan from the bank. Yes, in 2 years. Because this is now, it's a long-term liability. So cash will increase. Remember, the working capital is a current asset minus current liability. So if he takes money from a loan from the bank, current asset will increase, but the current liability will not be affected. So this one can increase the working capital. Paying 200 from Sally's personal bank account into the business bank. Yes, he's taking money from outside and put into the bank. So he's also going to increase the current asset. So this is also acceptable. Right? So actually the answer is 3 and 4. So it's D. Question number 33. Company X and company Y provide the following information. You can see gross profit here for X and Y. So you can see Y has higher gross profit, which we can conclude that it had yes, the gross profit margin was better. That means either sales were high or cost of sales were low, right? And the profit margin is this. So profit margin, that is now after expenses, right? So option number 1 here, it says that both companies earned the same amount of profit. No. Company X had better gross margin than company Y. No. But company Y had a larger proportion of expenses than company X. This is correct. Why is it correct? Company Y had a larger proportion of expenses. You can look at the comparison between the gross profit margin and the profit for the year. Here there is a much bigger gap than here. So that's why we can conclude that company Y had larger proportion of expenses than company X. Question number 34. The current ratio of X is 2 to 1 and the current ratio of Y is 1.3 to 1. What does the comparison of this ratio show? X had fewer liability than Y. No. X had more liquidity than Y. This is sounds correct. Why X had more liquidity than Y? Because X current asset is 2, current liability is 1. Actually, the current asset are double the current liability. So this sounds correct. Y had fewer current asset than X. Y had more inventory than Y. No, the answer is B. Question number 35. Which international accounting objectives are described by the following statement? Information in financial statement must be free from material error and bias. User must be able to identify differences and similarity between information in the different financial statements. Right. Statement 1, where we are having information that information in financial statement must be free from material error and bias. This is actually reliability. Information has to be reliable. So it's between C and D. Now the second one, users must be able to identify differences and similarity between the information in different financial statements. So this is about being to compare financial statement, not understandability. So the answer here is B. Right. Thank you very much for going through this paper with me. I want your comment. Okay, please do like and do not forget to subscribe. Thank you very much. Bye bye.